Hi, I'm Peter Rose, founder of Longwood Currency Trading. Forex trading systems work until they don't. I did a blog post about that a few years ago, and I'll leave a link to that. It was fairly technical and detailed in discussing systems as they relate to patterns and canned approaches to stuff. But I'm getting questions from folks, both in comments and mostly in emails. People, thank you for taking the time to email me instead of asking me complicated questions in a video comment, about what system I trade or how do I trade. And there's a simple answer to that, but if you don't understand the difference between the terms system and strategy, then you're not going to understand anything about any video that I've ever put out, because people are saying, well, what's your system? But really what they're saying is, what's the magic sauce? What's the simple thing that you can tell me for free in 15 words that'll allow me to make $60,000 a year? That's a good trade, huh? Well, if there was something that I could tell you like that, then everybody would know that, and everybody would be making $60,000 a year from their trading. So there must be more to it than the secret sauce. People look for the secret sauce in systems, engulfing candle patterns, golden crosses, London fucking open, and there's a lot of other things. Oh, when the RSI hits this, and I do that, blah, 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 and I throw a fib extension on, and magically I have an entry point and exit. It all sounds great, but it's all done after the fact. The folks that are doing it live in front of you are looking at price action, and they understand how to trade. And they say, okay, in their head, they go, oh, okay, I've got an entry point here, and I've got an exit point here, and let's firm this up. And then they throw a fib on it. And magically, one of those fib lines is where the entry level is and where the exit point is. Amazing. But that doesn't tell you anything, because there's absolutely no correlation between a fib level and a trading entry or exit point or congestion point. There's no correlation. I have a bachelor's degree in physics. I've studied quantum mechanics and thermodynamics and random motion. Almost a minor in math. I've been looking at the financial markets since the mid-1970s and the currency market since 2012. I've got a 40-year career in real estate, and I'm just here to tell you that fibs don't have anything to do with any of that shit. Think about it for a minute. Everything is based on randomness. Your decision to make your right-hand turn in your car is random. It's based on the fact that there's a road that you can turn into, but it's fairly random as to exactly when you start that turn. You don't say exactly 14.2 feet prior to entering the intersection is where I scar my blinker, and then I make my right-hand turn when I'm within a radial arc of 30 degrees to make the turn. That's not the way it works. That's not how you teach somebody how to drive. But this is what these people are trying to teach you how to do in trading. And a fib has nothing to do with where that person picked their entry point. It just happens that one of the close fib lines, 68.3 or 33 or 50, I don't know what they are, because they're ludicrous. You can measure tree rings with them and the population growth of rabbits and the height of a classroom of 4-year-olds, but you can't do anything with it within trading. I'm just telling you, okay? If you want to believe that stuff, believe some other political conspiracy theory or something, because all it's going to do is lead you down a rabbit hole to failure. Systems work, but then they don't. And they only work because magically this stuff is probabilistic in its nature at best. And you're dealing with price action which is collecting order flow, where you see the congestion points that these levels are being drawn at, as some magical thing. The levels aren't created by Fibonacci baloney or levels or anything else. The order congestion is created by order congestion. And what's creating the order congestion? Large institutional clients, not you as the retail trader. We're just shit dust in a big ocean. The large institutional traders have orders to fulfill for their clients. The currency market is almost $7 trillion a day. When I started looking at currencies in 2007, the market was $3.4 trillion. It's almost 7 now. And these guys are taking $1 billion order or a $500 million order or $4 billion, and they're trying to stage that in within certain price guidelines. The seller of the money doesn't want to sell it for any cheaper than X, and the guy that's going to buy the money to transact the goods transfer or whatever the money is being translated into from one currency to the other, doesn't want to pay more for it. So you have this dichotomy for this order of $2 billion. The client who's selling engine parts or something from one country to the other says, "Look, I've got to be buying dollars in order to transact this, and I got to sell pounds, and I got to sell francs, and I got to sell yen in order to create this sale that I want to go, but I don't want to pay more than X number of dollars, and the folks out there that are willing to sell their stuff, they're not going to go any lower. So that's where the spread comes from. You understand the spread between the bid and ask. If you don't, you shouldn't be watching this video. But the spread between the bid and ask is the same thing as the top and the bottom of an order congestion structure. So what do you think is going to happen to that that structure is repeats sort of, because when the guy starts out, he's starting out with $2 billion, and then he's dribbled some of it out, and then he's got to go away from it, step back from the desk for 2 or 3 days in order for the market to go and do what it's going to do and have other people do what they're doing, and hopefully other transactions between those pair of countries are within those same boundary conditions. If they are, then the guy can go back in and trade. But if they're not, then you go out of that boundary condition and you form somebody else's thing up here. So now I'm ready to trade again. So I go back in, and what happens is that another structure is formed, order flow structure is formed, that I can trade within those boundaries. And order flow structure, we're talking about resistance and support levels form the tops and the bottoms of. How far apart are those support and resistance levels? Well, first of all, they're not valid if you're drawing them on anything less than a daily chart, okay? Because that's what people trade on, is daily charts. The institutional investors. Well, the ATR on the major currencies runs anywhere from 80 to 120 or 130 pips a day, depending on the currency pair. If you're in the major 6, I don't know what they are in the crosses or exotics. You want to trade those? Go ahead. The spreads are unbelievable. But the bid-ask spread is the same concept that your support and resistance levels are. It's just expanded at a different level of transaction. So now you tell me how a fib has anything to do with that. Other than maybe the guy says, well, I'm going to pay 33 cents for this thing, and the guy that's selling is going to sell it is going to pay, well, I'll sell it, but not for anything less than 38 cents. Well, you're working with a couple of fib numbers there. So, I mean, what does that What does that really have to do with the underlying engine parts that are being transacted in the exchange? Nothing. Nothing. So you can continue to believe that. You can continue to ask me, what system do I trade? And I'm going to tell you the same thing. I don't trade systems because they don't work. And when they do work, that's great, but eventually they won't work because of the reasons I've just outlined for you. It has to do with order flow. So you don't waste your time, or you shouldn't waste your time, learning systems. That's not trading. That's just throwing darts at the board. You need to learn how to trade. You need to learn what order flow is. And whether you trade in currencies or stocks or old tires or bonds, it doesn't make any difference. It's all about supply demand, which is the manifestation, which is the result of the manifestation of order flow. Supply demand manifests order flow. And order flow is packets. If you study quantum mechanics, we talk about packets of energy, not flat energy bands. Like if you're listening to music and you look at the digital output from it, it doesn't go like this. The music goes like this. It has these these patterns. It'll go, and then somebody will say something, or a horn will go off, and it'll go like that, and then it'll go down here, and then a drum will go off, and boom, and you'll get a big spike. That's what order flow is. It creates those spikes based on the supply and demand between the two pair countries' currencies that are being transacted. And so if you're running a system, how do you model that on a system? You can model it, but it's only for a specific time. Like you want to model a trend following system, that's great. But what happens when the trend changes? What happens when you get a midterm swing point on what's called a retracement? Now, is that retracement going to be 10 pips? And you're fine, you're on a daily trend, and you got 160 pips of runway because the ATR is 160 pips a day at that point, and you take a 10 pip a retracement, you're okay. But what if the retracement is 50 pips and you're carrying a heavy load? What's that going to be? $3, $4, $5, $8, $10,000? And where does that stop? That swing may go to 60 pips. How far do you let it go? What, till you get margined out? That's what a system will do. That's where the system breaks down. It isn't that the market changes, it's that the order flow changes because the order is done. Quit asking me about systems. If you watch enough videos of mine, you'll understand that systems work until they don't. So why would you do something that's eventually going to break, and you're going to have to change what you do? If you learn how to trade, you don't have to change anything. I haven't changed my rules in, let's see, 5 years. I haven't changed my rules, and I only have 3 of them to do trade the whole system. System meaning the forex currency market system. That's a system. Now you have to figure out how to break that up into different problem domains, different problems. And that's what my 33-year career as a software engineer enabled me to do, was to look at the market system, the forex market system. What does it do? What's its purpose? And where are the problems that come up? And in software engineering, we have a thing called the Software Development Lifecycle, the SDLC. It's a series of steps that you go through to solve a problem. It's the same series of steps implemented the same way against different problems, but you get the solution because the solution of a problem is solved the same way. Now, you might do it at different times, and that's the difference. When you're solving the market system, the currency market system, you have 3 problem domains, 3 problems that you're faced with: entry analysis, position management, and exit methodology. Those are your problems that you need to solve. So I have one rule that solves each one of those problems. How much easier could it get? But it doesn't involve systems, because systems work until they don't. I don't want to work with something and then it's going to break. I don't want to work in a trend following system, because eventually the trend is going to swing either on a minor retracement or a major retracement, or it's just going to end and it's going to be the big swing and things are going to reverse. Why would I position myself in that? Why would I build a system to trade in a range bound price? Well, systems only trend about 33% of the time, about a third of the time. So the rest of the time you're in some kind of a range. Now that range could be slanted up or slanted down a little bit, but that doesn't make it a trend. A trend is price action contained within a narrow range band. A chop or a range bound is, it could be 300 pips, could be 60 pips, could be, if you're down on the 5-minute chart, you can see those structures, 20 pips. So the time frames that you're looking at, the currency pair that you're looking at, the time that you're looking at, where order flow is. Today I've got a big order that needs to go out. Tomorrow I don't have any orders on my desk. Some other bank would, but we're not privy to any of that information. Citibank has, as I said in the last 4 videos, 14 PhDs in economics and math sitting in a room somewhere doing the probabilistic calculations of all the fundamental data of all the markets all around to determine what's going to happen to XYZ pair when U.S. non-farm payroll comes out. Are you going to be able to match that and beat that? So you're not going to be able to trade a fundamental system based on fundamentals. Oh, I'm going to trade a non-farm payroll. I'm going to set a buy up here and I'm going to set a sell down here, and whichever one gets hit, then I'm in the trade. Ha! If it was that easy, well, what's going on? Well, isn't that what the London Open system is all about? Let's go to the London. Go to somewhere that explains the London Open. In its original context, it doesn't work anymore because all the retail traders think that it's going to work. So it's the retail traders that are banging away at each other, and the institutional traders really don't give a shit because they're just specks on a horse's ass, the little flies on a horse's ass. They've got $500 million to dump out, and this guy's got $500 million to buy. They're going to transact that during that London Open because that's when it becomes very active. The bank's open, and the rule says this is when you got to start trading. So they start trading, and price will go this way or that way. But it's not based on some system. You have to look at what's going on. What's the secret? We're going to pay somebody to teach you London Open? Look at the fucking chart on London Open and see what it does. It's volatile. It goes up and down and settles into a pattern of whatever, and then it'll either continue on that for the rest of the day or it won't. But it doesn't make any difference because if you're smart and you're trading logically, you can profit from that. But you're not profiting from it because it's the London Open system. You're profiting from it because you understand how to trade. If you're relying on somebody to teach you something stupid like London Open, a fib analysis, or what the RSI is doing, or Golden Cross, or you're not going to be successful because you're not trading. And you can't use a robot to do this stuff because you see the complexity that's involved in random and chaotic markets is not solvable by a robot. Even an AI-powered one. I got a degree in physics. I've studied this stuff. I write my own simulations. I understand random nature. Macau wrote a book, The Random Character of Stock Market Pricing, I think is what it's called. Go read that. It's full of differential equations and random theory and all kinds of stuff. See if you understand that. There's a lot of people who do, and that's what they're trying to write their systems against. A bank system is different than a retail trader system because they have more resources and they have more money and they can distribute their risk out over hundreds of thousands of trades. That's why the what do they call that? What was that book called? The Fast Boys or something like that. The guys that are doing the trading, they have the fiber cables. They try to get as close as they can to the stock exchange floor because millimicroseconds make all the difference in the world. All they're doing is clipping off the end of each of the bid-ask spread. they're maybe making 0.001 cent on every transaction, and they're losing 0.003 cents on the ones that they lose. But in the aggregate of the millions of transactions a day that they're doing, from a probabilistic standpoint, they're going to be okay. It's the same theory that in physics we talk about Brownian motion. Go look that up. Einstein had a lot to say about Brownian motion, because it's a pure thermodynamic probabilistic evaluation of the random nature of particles in a fluid. That's what its Brownian motion is about. But you can model trading systems and all kinds of stuff like that from a market standpoint. I do that. I've done that. But it doesn't do you any good if you don't know how to trade. Because if you rely on that, it's so complex it gives you the answer. And even when you plug it into a computer to do the simulation, I mean, look, that's what they do in weather calculations. Those are simulated models. Those are, call them a robot. When the model says to do this, put your fucking raincoat on. That's what a weather system is capable of doing. All you have to do is give it something to do when X criteria hits. But how many times have you turned on the computer for the weather and said, rain starting in 6 minutes? I get that on my phone all the time. Rain starting in 6 minutes. 2 hours later, it hadn't rained yet in my area. But it's maybe on another day, it's been raining for 2 hours before, and then the phone all says the rain starting in 6 minutes. It's probabilistic. Do not abrogate your responsibility as a trader to some friggin' system that has nothing to do with trading. Fibonacci's have nothing to do with trading. Structure and levels and all that stuff have nothing to do with trading. Trading is interpreting what you see as a function of what you see in the past, and doing analysis to determine what order flow will be in the next 5 minutes, because projections beyond that are pretty slim. If you are in business and you're familiar with the project planning process of using spreadsheet projections for future cash flow, you'll know that when you're doing a pro forma for a venture capitalist or for a bank financing or anything like that, you're doing projections out 5 years. Do you know how reliable those types of projections, and these are done by PhDs in economics and theoreticians and business people and the best minds in the world for this company, because the whole company is based on these future projections. You know how often that 5-year thing occurs? A lot of times the company's out of business by then. Anytime somebody came to me, because I did mortgage financing, I've done real estate, I've done business consulting, I've done all that stuff. Anytime somebody comes to me and throws a spreadsheet down and says, this is what this project is going to look like in 2 years. Yeah, okay. You've done it like 8 times, you should know better than that. It just doesn't happen. But if you can come close, that's good. But why would you want to come close at a trading at something that's going to happen a month from now, when you can get almost a guarantee the money's laying on the floor in 15 minutes or 2 hours? How long does it take you to get 20 pips? Well, 20 pips might be a little difficult unless you've got a really high momentum situation. But do you know the value of even 5 pips? If you could get 5 pips constantly every day, that's 0.5% on your money. 5 pips is 0.5%. You do that every day for 3 days a week, and you've got 6%. It adds up. But when you go into the woods hunting the big game, or onto the savannah, or in the tundra, hunting the big game, that big game could eat you too. Why take that chance? Go hunt a rabbit. Come back in and get warm and have a cup of coffee. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.